Okay, welcome back. Well, the market is doing just fine. It's up, as I said, just moved up to the high point of the day to almost 18,100 now. Jefferies is bullish on the Indian healthcare services space. They believe Indian hospitals are in a sweet spot. The broker believes that hospitals are a structurally strong story, and global health, which of course operates Medanta Hospitals, is their top pick. To discuss opportunities the local domestic market and, of course, international medical tourism as well. We are now joined by Dr. Naresh Trehan, CMD of Global Health. Dr. Trehan, great to have you with us here on CNBC-TV18. Appreciate your time as always. Could you, as I said, Jefferies, which is a global investment bank, has you as the top-rated name in the hospital space. Tell us how is international medical tourism looking, because that's a very profitable part of the business for hospitals. What have you seen in the quarter that has gone by? And if you can tell us what's the outlook for the next couple of quarters?
So good morning first, and thank you for having me on your show. See, overall, the India healthcare space has got a lot of headroom in the sense that we are still very underserved. So the story of India requiring more and more healthcare, more hospitals, more nurses, more doctors. The whole sector is moving at a very rapid pace because people have become more and more conscious of their health now, especially after COVID. And that we are now seeing a lot of traction from patients who are seeking quality and also getting the right advice for what their systems may be affected with, or trying to stay healthy. That's the big thing that has come, which is added on to the healthcare space. So now, when you ask about the international travel business, yes, it is coming back. It used to be like 12 to 15%. In our case, we are one of the leaders in that space. It's up to now 6-7%. So as the flights are being added on, as more and more countries are opening up, there is the concern about COVID is waning. There is definitely that interest that was there before is coming back and very robust. So we expect the upside on international value travel to be quite good. And also, if you know that we are going to be G20, hosting the G20 this year, the government has taken some very good steps to actually make it happen. As you know, our Prime Minister has announced serve from India, serve in India. So all these things, the healing process which we have described, puts us in a very good advantageous position as compared to other countries.
Okay, all right. Hi, Dr. Naresh. Good morning. Thanks so much for speaking to us. Well, you made some very valid points out there. Now, international medical tourism, which used to be 12 to around 15%, it's at around 6-7%, as you mentioned. So in the coming year, do you expect to go back to that range of 12 to 15%? And that has an impact on the average revenue per bed. So what's the outlook on that particular parameter? I think in the first quarter, it was in that vicinity of around 60,000 odd. Go ahead, Doctor.
So as I said, international travel for medical travel is coming back quite robustly and coming quite healthy from the countries that we had before. Some of the countries had had visa problems, all this other stuff happened because of COVID. Now they have opened up. There are hundreds of, patients waiting, not only for us, but for the whole sector who are wanting to come, because India offers, and we are in it, that we offer the highest quality of care at a reasonable cost. So India advantage is actually that we are offering those services not for poor medicine, but the highest quality of medicine that you can access anywhere in the world, but at a very, very affordable cost. So that advantage still remains. And we believe that this will continue, and even not only continue, but surpass the old levels.
Okay, so in FY24, you expect to go back to that 12 to around 15%. In turn, that would have an impact on the average revenue per bed, right? So any outlook, any kind of guidance you could give out there? And also give us a sense about the current occupancy rate. I think it was in low 60s. You were guiding that it goes to the higher 60s. What's it at now?
Yeah, it's there, but the point is that we cannot discuss our results. As you know, SEBI rules do not permit that. We will be announcing our results in the middle of February. So we will be giving this whole data. But like I said earlier, that COVID being over, travel opening up has brought back the patients who have need now, so that there is no hesitation in, because Medanta, Global Health, our main mantra is stick to quality and also maintain the highest end of care available anywhere in the world. So with that, people have shown a lot of confidence in us. Without giving you numbers, I can tell you that that confidence is very robust. And we are, as you know, we operate at a very high end, like lung transplants, liver transplants, heart transplants, kidney transplants. So all these things are actually our USP. So on one platform, we have all the services like cardiac. Cardiac, we have a very high-end services, all cutting-edge technologies available. Like you can talk about now the new frontiers. I mean, operating on patients who were considered inoperable before. We do it on a regular basis now. We are doing the percutaneous valve program. We are the leaders in that. And then there is even preventive health and predictive health. We are the leaders in. So those things we are concentrating on. And as you may have noticed, some of the best doctors have also even more have joined in. So we are looking at a very bright future from that point of view. And I think that our other services and facilities are also performing well. And the new ones are coming online. So there is from our point of view, the outlook is dependent on the quality of care we deliver. And that's what we are, is the core of Medanta. And that's what we are sticking to, and making sure that people will get the best treatment at the most affordable cost that can be offered.
Got it, got it. I also want to talk a little bit about the opportunity that you see, if at all, in the digital e-pharmacy space, because, you know, a lot of your peers are moving fast here. Apollo has got Apollo 24/7. They're getting funding into that business as well. Max has about digital as 15% of its sales. For Medanta, for Global Health, what is the kind of trajectory you see in this whole omni-channel platform space? And would you be looking to explore it further over the next few years?
Most definitely. What we have already done is started a very intense home care program. We have the pharmacy is already online, that we are actually in our space with our patients. We are doing extremely well. And then also along with that, the labs that people, because of their experience, of the quality they experienced with us during COVID, there are more and more people are seeking us for home pickup or home drawing of lab tests. So all these three frontiers are moving very well, and we are very cognizant of it, that this is the service we want to do, because we want to take medicine to the patient rather than patient coming to the hospital for every little thing. So this is the new realization across, mainly in the public, that yes, many services can be delivered at home. And the fact that you will see that during COVID, we got so used to the patients and us, all of us got used to video consults. Like if we were doing 100 video consults a day before COVID, we are doing several hundred now. All our physicians are very busy, so that people then get the benefit of their first consult on video. And then if they need something, then they come prepared to the hospital, because a lot of our patients come from long distance, and it's saving them a lot of trouble and money to travel twice. So instead of that, they can travel once prepared, knowing what they need. So all these things have been, all the levers have been activated, and they are actually growing rapidly.
Okay. All right. Thank you so much, Doctor, for stopping by. Wishing you all the best. And we look forward to chatting up with you post your numbers. Then we could discuss more on the outlook and the financial performance as well. Well, time to move on then. Metro Brands, that's the next corporate on our radar. The company reported a rather good set of numbers. Solid revenue growth in Q3, while margins as well were stable. Although their profit after tax was impacted, but that was on account of higher depreciation. To discuss more on the past quarter's numbers and the way ahead, well, we're joined by Mr. Nissan Joseph, this Chief Executive Officer who joins in. Hi, sir. Morning. Thanks so much for joining in. Well, congratulations on a good showing. The street has read these numbers positively. But you'd like to know a couple of numbers. One being, what was the same-store sales growth for the past quarter? If you could give us a sense of that. And also your gross as well as your EBITDA margins looked quite good for the past quarter. Do you expect to maintain these levels going ahead?
All right. Well, good morning, and thank you for having me this morning. Just to give you an answer on the same-store growth, we do not disclose those numbers. Having said that, though, I think any retailer today needs to target inflation plus 300 to 400 basis points, and we're well on track to hit that number internally, and we are very comfortable and excited about where we see our comp store growth going. So that's number one. And to answer your question regarding gross margins, we've always guided to 55 to 57%. Obviously, last quarter was also higher than that at 59% gross margin. But we're very comfortable knowing that we want to attain the 55 to 57% gross margin simply because we believe that that's the price point at which, that's the margin rate at which we can offer the best value to a consumer on a steady basis that we can continue to do so. So that's number one. And we always guided on our profits that, we believe that we can be between 15 and 17%. Obviously, last quarter was also higher than that. But those are the targets that we try to achieve simply because we think that allows us to position ourselves to have sustainable growth without putting pressures that become unrealistic and in some ways might increase pricing. And in the fashion world, you can increase pricing one quarter, but then you'll turn around and take markdowns the next quarter. So we want to have a very steady keel at a very steady hand at the keel for this business.
Sir, we wanted to ask you about that 15 to 17%. I think you're talking about the net profit margins, right? When you're guiding. We wanted to know what about the EBITDA margins. For the past quarter, it was at around, upward of around 30%. So what's the outlook out there? 34.3% is what you delivered in the past quarter, EBITDA margins.
And thank you for that. What we also guide to there is typically from the low to the mid 30s for EBITDA. That's a number that we've achieved for a number of years, and that's a number we zone in and want to achieve on an ongoing basis while keeping our growth rates continuing to be high.
All right, got that. I want to talk a lot about how your e-commerce sales have picked up in a big way, and this is the highest ever quarterly e-commerce sales. But before I ask you that, are you on track about your store opening target? I mean, you had a target of 260 store openings in the next 3 years. How much have you done up until now, and what's the expectation in the next 3 years?
So in the 3 quarters of this year, we've exceeded 90 stores, Sonia, in growth out of the 260. So the math extrapolation would be we're ahead of target on that. And that's a number we're comfortable with. We guided to 260 stores, as you mentioned, and we're very comfortable we'll hit that number. So there's no risk on us not achieving that number at all.
Okay, so there's no risk. You will achieve 260 store openings in the next 3 years. Tell us a little bit about what's happening with e-commerce, because you've done 50 crores, which is, I think, your highest ever quarterly e-commerce sales. How much would the e-commerce space contribute as a part of your total business in terms of a percentage contribution? How much do you think it could go up by over the next 1 year? And what are you looking at in terms of a quarterly run rate?
Right. So I think there's a couple of things here that I want to speak to. One of that is that last quarter was the first quarter that we had that's what I call a normalized quarter, right? So for years, we've been comparing it to current year -2, -1 because of COVID impact, right? So we were able to compare our numbers to last year, where the markets had opened up and people were back shopping again, right? So that was very positive for us. Last year, at the same time, you asked me if there was pent-up demand. You asked me if there was wardrobe refreshes. And I think we had all of those happen in Q3 of last year. And the great news is we've comfortably come ahead of that in Q3 of this year. So that's number one. While doing so, our brick and mortar stores have come alive very rapidly and very excitingly, but we've also noticed it has not come totally at the expense of e-commerce as our e-commerce continues to grow. We believe that digital sales are critical for a company. At the same time, you've got to watch that they don't in any way diminish your brand or erode your brand. So we right now are at 8 to 10%, and that's a number we're comfortable with simply because we believe our consumers, especially in the footwear space, like to touch and feel shoes as they buy them. So they're going to lean and be more inclined towards shopping more in a store environment, which is great for us because we have a lot of them out there. But it doesn't mean we're going to walk away from e-commerce. We're going to continue to want that channel to grow at or better than the rate of growth for the entire company.
Mr. Joseph, but you're saying e-commerce is 8 to 10%, and you want to keep it that way. I mean, wouldn't it be better if that grows substantially? And I mean, that would mean lesser number of stores. I mean, you need stores to service this demand coming through the digital channel, but not so much if the proportion increases, the e-com proportion increases. So yeah, go on.
So what we look at it is from a profitability standpoint. We have deep financial discipline at Metro Brands, right? And I think if you look across the landscape, there's not many companies that come in with the profitability of us, definitely not in the e-commerce space, right? So when you look at that, you would ask me, why would you want to grow e-commerce if it's not as profitable as the rest of your business? Having said that, though, we're totally aware that the consumer is digitally savvy and expects you to be online, expects to have a digital experience, but it's really more about a 360 experience for the consumer. What we find is they're doing a lot of offline to online, simply because they want that journey. They start their journey online, but they finish their journey offline. So while we may not want to see digital sales specifically grow to a target number, it does not undermine the importance of digital in our portfolio. But I also think it underscores the importance of brick and mortar in our industry.
No, so is the e-com strategy? I think other footwear companies like Bata, etc., also do that. They don't stock all their products across stores in every store, but they are able to give you a sense of, and then you kind of you see what you like, and then you order online. Is that broadly the way that you were looking at e-com as well?
Yeah, the part about e-commerce that excites us most is what I would call the omni-channel business, which is what you're referring to, where customers can see my entire breadth of inventory, and then they can have it delivered to their houses very quickly because we ship it from the nearest zip code. So that is a very exciting proposition for us. What does not excite me about e-commerce is, and you find that people that start getting into the high double-digit ranges also do so with a lot of discounting, and we're not in that game. We're here to provide customers value at a premium price.
All right, Mr. Joseph, very quickly, you've given us most of the numbers. So the stock is at the high point of the day as we speak. Last year, you did around 1,350 crores. This year, you're going to end in that vicinity of around 2,100 crores, just trying to extrapolate numbers. But on whatever you finish in FY23, what kind of a growth you're looking at for FY24?
So, we've maintained a CAGR growth of over 17%. Right now, our CAGR has jumped up because of the last couple of quarters. Yes. Metro is one of those that believes to have a steady business going as opposed to, have peaks and valleys. So it's not like we target to say, let's get up to a 30% growth or a 40% growth at the same time, turn around and have a year where we don't have any growth. It's about having a steady, double-digit growth maintained for the many, many years.
So high teens.
That's definitely something we would be doing, yes.
Okay, all right. It's been good speaking to you, Mr. Joseph. Thanks so much for stopping by. Your stock is at the high point of the day. It seems the street likes what you just said, so the numbers go on with a thumbs up. For the time being, the markets as well are doing pretty well. We'll slip into a short, we'll come back. We'll get our technical experts back with us.
Welcome back. It's 10 a.m. So let's get our technical calls in now. Mitesh Thakkar is joining in. Mitesh, good opening for the market, at least holding with gains of over 56 points now. Your thoughts? Do you think this 18,100 level can see some gains built onto it? And what are the stocks to watch?
So, we've been talking about possibility of testing around 18,150 to begin with. And I think we'll maintain that kind of outlook. My belief is that I think 18,150 is the first pivot. Eventually, this rally can even extend to about 18,250. So with that kind of a view, clearly trading with long buys, I have Oberoi Realty as one of the stock to trade. That's a buy with a stop below 847 and a target of around 880, 885 could be looked at. And the other stock is Lupin. That's also giving a good breakout on the intraday chart. So here buy with a stop at 750 for targets of 785.
Okay, all right. By the way, Mitesh, thank you very much for that. We are also at the 20-day got taken out yesterday. And this morning, what we said is the next level is the 40 exponential day moving average, and that is at 18,116. And as we speak, we've crossed that level. We're at 18,120. So this is looking good, and gains are coming on pretty fast now. Some momentum which has been missing on the upside, that showing up in the last 2 hours of trade yesterday and today as well. Now let's talk about commodities and what's happening there. Manisha is standing by as always to tell us what is top of mind. Manisha, hi, morning.
Morning. Top of mind is metals, Prashant, and within that as well it is copper, which has been doing quite well. January actually is going to be a second straight month of gains continuing in case of the copper prices. And as I've been telling you, the low that we started, that upline trend was from 640 of a level and 772. We haven't seen a meaningful correction in case of copper prices since then. It has been about lower supplies, increase in demand that has been supportive, is the reason you have the copper prices right now trading at a 7-month highs there. There are inventory concerns, yes, and production concerns also, because Peru is facing its worst civil unrest in last 20 years. There are supply concerns because of that. And Chile, which is the other major producer of copper, is expecting 6% of a decline in production in 2023. Well, that's about production there. Take a look at, in sense of inventories, that and LME and Shanghai futures inventories at 186.4 thousand tons is just about 2 days of global consumption. And it's not just about copper. If you look at overall LME inventories, we ended 2022 nearly half down of what we ended December 2021 at. So there have been sharp declines in global inventories across market when you look at all of those metals there. So 654,000 tons is what 2022 ended at. And from this as well, nearly 50 to 60% of tonnage is waiting for physical loadout. That would mean much of this metal is already marked for physical deliveries. So what LME would remain with is at around 357,000 tons of metals, and that's just about it. And that is the reason you have seen this 8 to 15% of a jump up in the month of Jan for many of these metal prices. When you look at copper itself, well, the Shanghai warehouse stocks ended 2028 at the lowest since 2007. So we have seen decline not just on LME but in New York and on Shanghai exchanges as well. For copper, essentially, we are looking at support also because the net longs on COMEX are the highest since April 2022. So people are believing in metals and in copper. And the first half of January actually is about weightages, reallocations of funds. And we have seen some of that come in for copper. Now, China is heading for Lunar New Year holidays in the next week, so there has been some restocking ahead of that. But the next week is expected to be quite calm. Also, the weak Chinese data that we've seen come in for the month of December can weigh onto the markets in the next week. This week, we still are looking at some restocking support. For the day today, it is going to be about the US PPI, retail sales, industrial production data. All of that is coming in today, and ahead of that, we have seen some strength in dollar index. That could also lead to some profit taking, is the reason you're looking at very slow gains into the metal prices right now. When you look at the outlook there, most people do believe that copper prices can gain from here. There are expectations at 772. We could be headed at 780, 810 as well on the higher side in days to come.
Okay, thanks a lot for that. So that's a big move that we're seeing in the metal stocks, or rather the metals itself. Let's get back to stocks now. Vivek is tracking RVNL and Siemens. Vivek, over to you.
Well, that's right. It's the second consecutive day where Siemens has actually gone ahead and given an update as far as, order inflow is concerned. So consortium of RVNL and Siemens has actually emerged as the lowest bidder for 2 metro rail projects, one in Surat and the other one in Ahmedabad. Now, the Surat metro rail order is worth a little over 670 crore, while the Ahmedabad metro rail project order is worth over 380 crore. Now, this particular consortium is in the ratio of 65 to 35, with Siemens having a 65% share. Macquarie has also written on this particular development. What they're saying is that for Siemens, the strong order awarding momentum is something that continues to be seen. And in fact, what they're saying is that this particular order implies an order inflow of a little over 680 crore with an execution timeline of 19 months. Now, what they're saying, the locomotive segment is going to be the key driver for Siemens order inflow, at least in the near term.
All right, Vivek, thanks very much for that. 75 points, looking solid with exactly an hour of trade behind us now. We take a break. On the other side, our special segment, it's the economy. My colleague Lata will get chatting with Srinivasan Varadarajan of Union Bank to discuss if the sluggishness in the cost of capital continues in 2023 as liquidity decreases across global markets. Stay tuned for that conversation.